All right, let's start off with the FTSE, if you don't mind. Very close to a record high, still within 1% of its record high. Today, we got some data about the UK economy in contraction very slightly. Does that change your view on the UK right now? And also the fact that while the UK is not necessarily in the EU, that the European Union could face some tariffs?
Well, I mean, I think everybody's concerned about tariffs and what they might do and what the impact might be to the UK and to European countries. Obviously, there was a tariff letter sent out with a 35% tariff on Canada this morning. That's roiling the markets. But I think ultimately, it's not about whether it's Europe or the U.S. I think the U.S. is looking to make these trade deals so that it benefits everybody. And I think you could see that European markets have recovered because at the end of the day, I think once we get past the noise, we should have a good result for our, for the U.S. and for our partners. And I think both Europe, the U.K., and the United States should all be able to do well in these markets.
All right, so it sounds like you're saying it's a rising tide that lifts all boats, but from this point right now, you see the stocks just a bit above the S&P 500. As we go to the second half of the year, we're already kind of in there. Which boat do you see rising the highest? Is it time to turn your attention back to the U.S.? Or do you think there's still a thesis that with rate cuts in Europe, that there's more opportunity in the markets there?
Yeah, I think Europe could still be attractive. And again, I don't think it has to be one or the other. I think it can be both. And I think there's certain sectors where you can look to gain the benefit of both markets. So right now we like defense. Whether you're in Europe or in the United States, NATO members have decided that they're going to increase their commitments by 2035 to 5% of their GDP. And we've seen defense do really, really well year to date. And we think that can continue as spending on missile defense and arms and munitions continues, with all the geopolitical risks. We also think financials are doing really, really well. So when you think about the largest financial institutions in the world, the GSIBs, they've been outperforming year to date. And I think that's because of their size and scale, the fact that they control most of the cash deposits, and it makes them less interest rate sensitive. It also makes them a part of the overall investment in both Europe and the United States.
So, Paul, one of the ways that you're saying that people can kind of play some of that increase in defense spending is your NATO ETF. We're just showing it up about 40% year to date. Very quickly, give me a sense of what's in that ETF. Is it all defense stocks or some other areas as well?
No, so it's all defense stocks within the NATO member countries. There's about 72 holdings. It's a passive strategy. It's basically designed to give investors exposure to defense companies that are part of the NATO membership.